Welcome to our first update of 2023 as we get through the first quarter. And as always, there are hundreds of moving parts all over the place that are affecting our livelihoods and our investments as well. Locally, there's been the SONA update recently with very mixed reactions to the state of disaster for what are they calling a super crisis with our electricity. I tend to agree. I think we are on day 7 without power at the moment. And we'll be dealing with whatever comes out of the national budget a little bit later. Offshore, there have been major developments as international companies have been declaring their earnings. Inflation, lots of talk about where that's heading. China has changed its stance on COVID, no longer that zero COVID policy, and opened up its economy. So that's had a big effect. The war in Ukraine just keeps going way beyond expectations. And as we all know, the devastating earthquake in Turkey, terrible for all those people affected, but also economically to raise billions of dollars off their market. Now, each of these events have had varied impacts on our economy. For example, China opening up its economy creates this wonderful positive sentiment for emerging markets like South Africa, and especially as a commodity producing country. But then our electricity woes weigh heavily on our rand, and we can see it very weak at the moment, although that is also got a lot to do with dollar strength, not just rand weakness. And usually that goes sort of hand in hand with bond prices, but actually that hasn't been the case. Foreigners have been buying government bonds because of this sentiment around emerging markets, and also because commodity prices are expected to remain high. They have not been investing in new mines for a while. So that supply can't just suddenly be increased. So when the demand increases, the prices will remain high, which means expected high tax revenue for South African government for this year, which reduces their debt and therefore creates this positive sentiment around bond prices. As mentioned, inflation has been this big scary monster. We've been talking about it for a long time, and last year the effect of the rising interest rates to counter inflation was fully felt. The S&P 500 last year in the US had its worst year in 100 years. Thank goodness we avoided a lot of that, but yeah, that was really affected and sort of brought markets back to reality in a large way. Now inflation seems to be slowing down, which is really positive. The need for raising interest rates is not so high, but who knows where things will go in 2023. This war in Ukraine is definitely not over, and how that could affect energy and food prices, we'll have to wait and see. At least it is positive for those of us who are paying off a home loan. So just to share my screen, just to show some of the slides here. Returns for the past year. As you can see, the South African market in the last year has done relatively well, and mostly that's because of the last few months. Bond market has also done well. Property has not done well, and that's same local and offshore, and that probably will stay like that for a while. Money market, because of interest rates going up, is doing better. And interestingly, offshore in dollars, it's still negative, even after the very good first bit of this year and end of last year. That's because of that massive drop during the year last year. But in rands, it's positive because the rand is weakened against the dollar 18% over the last year. So if your money had been offshore, although that hit had been felt in rands, it's not as bad. So just to show you an example of how things have improved with these improved inflation expectations. So this is a snapshot of one of our clients in our balanced portfolio, typical saving towards retirement type of portfolio. And in the last 3.5 months, from the end of October, 12.49%, and that's after fees and everything. So that really just illustrates that point and how much things have shot up over the last couple of months. Just to explain some of the changes that we made. So towards the end of October last year, you would have seen some notification about the fact that we made some changes, and that was to bring some offshore exposure in our portfolios back into rands. That was because the rand was really weak at that time. Now looking back, if you look at this graph, we couldn't have timed it better, you could say. Straight after that, it did start strengthening, and that really helped our portfolios over that time. But obviously, as you can see, it's come down again. But it's still now, again, trading way below sort of fair value, you could say. But that increase combined with these other effects that we've just mentioned shows that, I mean, this is a client of ours in our annuity portfolio. So that's the sort of retirees portfolio. You're drawing money for an income. She came in right at the end of last year, and this is really 6.7% up just in the last sort of month and a half. Just to show a bit of reality, though, this is another client of ours, same portfolio. She's been in there for a bit longer, and you can see the effect of 2022. Nothing like offshore, how bad it was, but we were definitely affected. But this last little bit just shows how much things have shot up over the last couple of months, thanks to all these things we've just mentioned. So we are, just to speak about some changes, we're also looking at some changes to some of the funds that are included in our portfolios. As management in funds keeps changing, that keeps getting reviewed by us and by Fund House, our partners, and also some funds that have been building up a really nice, good track record we're looking at now, maybe including. So we'll let you know about that if and when that happens during the year. But what to sort of expect for this coming year? We recently went to a presentation at Allan Gray, and one of the presenters from the fund manager of Schroders, they are included in our offshore portfolios. She put it together so nicely in the slide, I thought I would just steal her slide, because a lot of the fund managers were speaking about these topics and how we can sort of expect things to go. And she basically was saying, let's enjoy this party. So this massive increase that we've seen in valuations in our portfolios, let's enjoy it, because a lot of these factors are going to weigh on returns. Inflation will not get down back to what it was, because labor, greenflation, things like that are here to stay. Obviously, labor shortage, they're talking about skilled labor and not in South Africa and in the US, but that affects inflation, that affects the whole world. Tighter monetary policy, so we've been seeing all this money being thrown at markets in the past. That's not going to be happening as much, just because they can't afford to. More volatility in politics because of inequality and things like that we can expect to increase. Supply chains will not be the same. So COVID really showed that having a global supply chain, while it's good for prices, when there's a breakdown in supply chain, it's a real problem. So a lot of companies now looking to bring their supply chains closer to home, but that affects prices. And technology, huge changes in technology. I'm sure you've seen ChatGPT and all the talk around that. So that is going to be positive for certain companies and negative for others. So what this does show is that we can probably expect, markets to level out a bit during the year. What effect the sort of recession and how bad that will be? Some commentators are even saying it won't even be a recession, but we'll have to see. But with all of that, will weigh on returns. But it does highlight the importance of using funds where they actually have the capabilities to do proper research on specific companies, because these themes are not going to affect companies in the same way. And we just wanted to show you that our partnership with Fund House that does the research on the funds, it is working. If you have a look, this is our balanced portfolio versus the industry average for a balanced portfolio sort of in South Africa. You can see over the last year with all this volatility, a big difference, almost 3% difference in return. So we're very happy with that. And even going over a longer period, if you look back at the last 10 years, the percentage difference is less, but it's obviously still a big difference in rands when that gets compounded. So this is working. We're just happy to see that. We wanted to let you know that, because it's going to make more of a difference as we go forward with all these different factors weighing on industries in different ways. And I finally just wanted to finish off with this slide. If you've been wondering why your budget doesn't always work as it did maybe a year or two ago, we mentioned earlier that companies have been reporting earnings which are still positive. In fact, 70% of the reports so far are surprised to the upside. But this is why. This is what the prices have been doing on the left-hand side, and on the right-hand side, volumes. So there's basically less people buying, but at much higher prices. So again, just reiterating the idea: avoid debt at all costs wherever possible, and invest wherever you can, because that will hopefully see us through some of these challenges. Otherwise, looking forward to hearing from you. Otherwise, thanks very much for watching. Cheers.